Hey everyone, welcome back to my channel, The Finance Fix with Dimut. Today we are diving into something that's got the whole finance world buzzing. Yup, the Reserve Bank of Australia is widely expected to cut interest rates next week, and all three major banks are backing at least a 0.25% cut, while NAB's prediction is big 0.5% cut. So, what does that mean for the ASX? Well, rate cuts can be a big deal for the stock market. They lower borrowing cost, boost business confidence, and often send certain sectors like real estate and consumer stocks soaring. But it's not all good news for everyone. In this video, we'll break down how the RBA's decision could shake up the ASX, which sectors might benefit, and what investors should be watching closely. Let's get into it. Alright, so let's break this down. Why does a rate cut from the RBA matter so much to the stock market? Well, when interest rates go down, it becomes cheaper for businesses to borrow money. That means more investment, more hiring, and potentially higher profits. And for everyday Aussies, lower rates can mean smaller mortgage repayments, which frees up cash to spend elsewhere. All of this can give the economy a bit of a boost, and the stock market loves that kind of optimism. But here's where it gets interesting. Not all sectors of the ASX react the same way. Real estate and consumer discretionary stocks usually get a lift because people are more willing to spend and invest. On the flip side, banks might feel a bit of a squeeze because lower rates can eat into their profit margins. So depending on where you got your money, a rate cut could be a win or a warning. So what exactly is the RBA? What does it matter? The Reserve Bank of Australia is our central bank. It sets the official cash rate, which basically influences how much it costs to borrow money across the entire economy. Every time the RBA makes a move, it's aiming to keep inflation in check, support jobs, and make sure the economy stays on track for all Australians. When the RBA cuts interest rates, it becomes cheaper to borrow money. That's great news for business looking to invest and for consumers ready to spend. All that extra activity in the economy can boost company profits. And when profits go up, stock prices on the ASX often follow. Some sectors rally and shine when interest rates drop. Take real estate. Cheaper mortgages mean more people buying property. Retail also gets a boost because consumers are more willing to spend. And utilities? Yes, they benefit from lower financing costs, which can make their operations more profitable. In May 2025, the ASX 200 surged 0.6% to 8,343 points, its highest in weeks, as investors grew confident that the RBA might soon cut interest rates. This optimism around monetary easing sparked gains across the market, especially in rate-sensitive sectors. Real estate stocks jumped on the prospect of cheaper mortgages, while healthcare shares climbed on expectations of steady demand and better funding conditions. This rally highlights how closely the ASX tracks RBA policy signals and why investors are watching every move. Ever wondered how a simple interest rate hike by the Reserve Bank of Australia can shake up the entire economy? When the RBA raises rates, borrowing becomes more expensive. Businesses may hold off on expansion and consumers often cut back on spending. This slowdown in economic activity can lead to a lower company profits and in turn fall in share prices, especially in rate-sensitive sectors like real estate, retail, and financials. It's a powerful reminder that monetary policy isn't just about banks and loans. It sends ripples through the whole market. Now, let's talk about the flip side, because not every sector allows rising interest rates. Real estate usually takes a hit first. As mortgage rates climb, housing becomes less affordable and demand starts to cool. Retailers feel it too. When people are paying more and more on their loans, they tend to spend less at the shops. And even banks, which might benefit from higher margins, aren't immune. If rates go too high, the risk of loan defaults increases, and that can put serious pressure on their bottom line. Now, here's an interesting twist. Back in February 2025, the RBA actually cut interest rates by 25 basis points, bringing the cash rate down to 4.1%. You would think the market would cheer that on, right? But instead, the ASX 200 dropped by 0.6%. Why? Well, investors weren't just reacting to the rate cut itself. They were reading between the lines. The move raised concerns about the broader economic outlook, suggesting the RBA might be seeing signs of weaknesses ahead. It's a reminder that sometimes a rate cut isn't just about stimulus. It can also be a signal that trouble's brewing. Now, here's something important to remember. Markets don't just move based on what the RBA does, but on what investors expect it to do. So even if the Reserve Bank cuts interest rates, that doesn't guarantee a market rally. Why? Because if investors are still worried about future rate hikes or signs of a slowing economy, that rate cut might actually be seen as a warning sign, not a boost. It's all about expectations and sentiment. That's why sometimes good news doesn't move the market and bad news doesn't always crash it. It's the psychology behind the numbers that really drives the action. Now, here's something that often surprises new investors. A rate cut doesn't always mean the market will go up. Why? Because markets are forward-looking. If investors believe that the RBA is cutting rates in response to deeper economic problems like slowing growth, rising unemployment, or weak consumer demand, they might actually see the cut as a red flag, not a green light. On top of that, if there's any hint that this cut is temporary and more rate hikes could follow, confidence can quickly fade. That's why sentiment and expectations play such a huge role. It's not just about what the RBA does, it's about what the market thinks they'll do next and what that means for the economy. I hope you understand and learned something new from this video. If you found this helpful, give it a thumbs up, share it with your fellow investors, and don't forget to subscribe to the Finance Fix with Dimuj for more bite-sized finance lessons and Aussie market insights. Thanks for watching. See you in the next one.